Hello, and welcome to the latest Structured Finance in Focus podcast. My name is Côme de Montpellier. I'm a senior director in Fitch's Cover Bonds rating team, and today I'm joined by Natasha Guerrer, who's a director in the team based in London. On this episode, we will be discussing our latest Cover Bonds rating criteria, which was republished on the 11th of September with a couple of significant updates. So jumping right in, Natasha, can you briefly tell us what these are?
Yes, of course. There are two main changes. The first is to our resolution uplift analysis. The resolution uplift reflects the favourable treatment of covered bonds in a bank resolution. The update is more about refining how we analyse the resolution uplift than fundamentally changing it. And the second change relates to our break-even over-collateralisation for the rating, or OC. Very simply, for many programmes, we will now apply a haircut of 25% to the level of OC supporting the covered bond ratings, and both changes have no ratings impact. The resolution uplift will increase to 2 notches for a handful of programmes, and this will increase the buffer against an issuer downgrade for these programmes. Whereas the reduction to the break-even OC for the ratings will apply to most of our programmes, as to be eligible for the haircut, the resolution reference point, which is the issuer rating combined with the resolution uplift, must be at least BBB+, and that makes up the majority of our programs.
Thank you, Natasha, for this high-level summary. So getting into the details now, let's start with the resolution uplift. You said that fundamentally, our analysis hasn't really changed. It's more that we've refined our approach. Can you elaborate on this for us? What has changed and what's the same?
As you said, what we're analysing hasn't changed. The resolution uplift still reflects the favourable treatment of covered bonds in a resolution of the issuer, which leads to a lower vulnerability to default than senior liabilities. Since we have more clarity on the resolution path for banks and on the likely impact on their covered bonds, we now make a distinction between issuers that have raised resolution debt buffers and those without debt buffer. So we no longer distinguish between issuers that have a rating based on support or based on their intrinsic credit quality. With the new criteria, the main differentiating factor is whether the bank has raised debt buffers, such as MREL. If yes, the programme is eligible for the maximum 2 notches of resolution uplift. In the absence of debt buffers, we then look at some other factors which would indicate the likelihood of cover pool enforcement in a resolution scenario. If the covered bonds are issued under a legislative framework and are secured by standard cover assets in a country where covered bonds play an important role in the funding of banks, they can still be eligible for the maximum 2 notches of resolution uplift, even in the absence of debt buffers. However, if all these conditions are not met, then the resolution uplift may be 1 or 0. For example, covered bonds issued in a country where the legislation is quite nascent may only have 1 notch. And again, this is in the absence of debt buffers.
Understood. And which program would get 0 notches of resolution uplift?
Examples of programs that may get 0 notches are non-bank issuers that would not be subject to a resolution framework, or banks that have no debt buffers and issue covered bonds under a contractual template with assets that are non-standard for their jurisdiction. And by standard assets, we mainly mean residential retail mortgages or public sector exposures.
Okay, thank you. And as we said, this update only affects a handful of programs and will lead to an increase in the resolution uplift, so it's positive because it increases the buffer against an issuer downgrade. Let's turn now to the other big change, which is the 25% reduction in the break-even OC for the rating. This applies when the resolution reference point for the cover bonds is BBB+ or above, and this affects the majority of our programs. Can you tell us what the rationale is for the haircut?
Sure. So far, our approach has been to calculate the break-even OC for a covered bond rating in line with stresses associated with that rating. For instance, AAA stresses for a AAA covered bond rating, irrespective of the rating of the issuer. This has the advantage of stability because the break-even OC is stable even if the issuer default rating is downgraded, as long as the covered bond rating is still achievable with the notches of uplift. However, This method didn't give credit to the recourse of covered bond investors towards the issuing entity. In order to better address this dual recourse, we now recognise that the issuer will absorb some of the stresses in the programme before it fails, and there's a switch of recourse to the cover pool. We reflect this dual recourse by applying a haircut to the break-even OC when the issuer's resolution reference point is BBB+ or above. And, just to be a bit more specific, we will also only apply this 25% haircut if issuers have sufficient eligible assets available for their programme. The reduction in break-even OC for the rating applies to the majority of our programmes, but it has no rating impact. And this is because none of our ratings are constrained by over-collateralisation.
Thank you for the rationale that for issuers of a certain credit quality, we no longer size for the full break-even OC, as we are giving credit to the dual recourse. Can you explain why the haircut is 25%?
It's linked to the relativity of our stresses in structured finance and covered bonds. A stress in the BBB category is about 25% of the AAA stress. So the idea is that an issuer rated at least in the BBB category would absorb 25% of the AAA stress. We already apply a similar concept in our mortgage insurer's rating criteria, where we give credit to an insurer's financial strength according to its credit quality.
Thank you, Natasha, for your insights. And many thanks for following this podcast. You can find more information about our cover bond rating criteria and our cover bond ratings on Fitch Ratings website. Thank you.